Good morning. My name is Scott Redler, Chief Strategic Officer of T3Live.com.
And I'm Jill Malindriner with The Street, and together we bring you the final morning call of 2012. We have 3 trading days to go, including today, but there still is a lot of macro headline risk that we have to pay attention to. Thin, choppy trading, but we have Obama coming back in town, back to Washington, and there's going to be some fiscal cliff language that we're going to have to work around.
Right, and we also got some new language from Geithner saying that we're going to reach a debt ceiling on Monday, so that adds some fuel to the fire. So maybe with that potential deadline and Obama coming back, futures are up 3-4 handles. So I do think maybe some guys out there are optimistic that something can get done. Maybe some kind of Band-Aid deal. Considering you have to be a bit careful. We just had 3 down days. We were as high as almost 1450, so now we're into about 1420. So this little area of the market is very important for short-term direction.
Right, because I also think, and we'll take a look at this in the sector spotlight, that a lot of the action from November 16th, that key reversal day, up into where we are now is almost like buy the rumor, sell the news. And we've seen that in terms of how we've come off over the past 3 days. So let's take a look at the SPX and see how we're positioning going into trade today.
Right, I think a lot of guys are trying to stay with positions that they like, but with this faulty type action, they're just doing it with a little less risk, a little less tier size. So if, you remember when this first or the most recent trend broke right here, where it was risk off right around 1440. From there, you had a what was it, 6-7% move to the downside. Here was that reversal of November 16th. This was an area to switch gears. You had a somewhat powerful move the day after, and then from there we've been trending to the upside. Okay, we did hit a high right around, this 1450 area where you had a lot of congestion. So, decent spot for people to take some profits. But then if you take a closer look right here, you will see that, we pulled in 3 days. We're right at this this trend line here. It's trying to hold it. It's above it right now. I would say short term, you want to watch this 1416 to 1413 area. If we start to break below this, you'll see some intermediate guys probably get away from their portfolio approach and get back to tactical. But as of right now, I think the market's a bit bent, but it's not quite broken yet.
Well, one of our big themes for 2012 is certainly going to be CapEx spend, and the technology sector will certainly get some support from there. So let's check the temperature of the Qs.
Yeah, and right now, we did see a move off the lows, but there's really no power. There's no real energy in the Qs, and I like to see technology lead. And right now, I wouldn't say it's a huge red flag that it's not, but if it starts breaking some of the support that I see right here, it could, bring out more sellers, so to speak. So you look at the chart here of technology. If you remember, this was a forward-looking scenario when we broke down. Right here, when technology broke in early October, it broke its trend line and retested and went lower well before a lot of the other indices. So you look here, you did have a decent reversal, came back to this trend line, somewhat failed. And look where it is. It's on some pretty big support. It's already, I think, back at the 200-day moving average. A lot of people aren't talking about it. I would say if the Qs start to break below yesterday's low of 64-ish and really closes below it, some people will notice, and that'll be a little bit of pressure as we start, in January.
Moving along to the sector spotlight, we're going to take a look at the retail names. Consumer spending habits were pretty strong for 2012, which I think was a nice surprise for everyone. But we've seen this group really start to come in a bit since the first or second week in December. Preliminary sales data suggests that 2012 really wasn't as strong as analysts' projections, although these numbers tend to be very, very arbitrary because they're based on foot traffic and what an analyst perceives sales projections are going to look like. So there might be an opportunity in here to get involved at some of these lower levels, but I think if you look at the XRT or the RTH, the ETF or the group, there really is some support levels that look like they're going to be breached.
Yeah, or at least tested. And right now, when things are under pressure, there's no reason to get in the way until you see some type of reversal pattern. And if you look at the XRT, you will see that it just started to potentially engulf and break this upper area. This was your resistance where it failed to get back through. Yesterday, if you look at it, it closed on the dead lows. Through these moving averages that are curling over. So that's never a good sign. So the 200-day is right around 60.40. At this point, short term, maybe watch yesterday's low as a pivot, but overall, you have a really big gap here now, which typically leads you to the direction. The direction of this gap is down, a pro gap, and here's your wide range follow through. So I would say, really watch to see into the new year how it handles this zone. At this point, I would be very, very light retail.
Moving along into the individual names, TJ Maxx, which has certainly been a darling of 2012, another one too, where it came off a bit more of that buy the rumor, sell the news.
Yeah, and this one also, it was one of the favorites, and they've been selling a lot of the favorites, whether it's because people want to book in, book profits because they know they're going to be paying higher taxes next year. So it's different this year. It used to be like strong stocks and stronger. This year it's like strong stocks are getting sold because people don't want to give the money to Uncle Sam. They'd rather put it in their pocket. Combine that with some retail sales that weren't as highly or lofty as the analysts say, and there you go. You have some selling pressure here. You look at the chart here, you will see two different trends. This is one trend that broke in TJ Maxx, and then shorter term, it looked like it was back in the game right here on that low. And then right here, when it breached this 42 area, if you were uncommitted, that was a bit of a sell signal. And now look at it. It closed below the 200-day. I just showed you the XRT, not near the 200-day. TJ Maxx closing below. That's showing you relative weakness. That means take some risk off and get out of the way there. My 200-day moving average rule is if it doesn't reclaim its 200-day moving average within 2-3 days, where it's like a sell trap, it's going to go lower. So if it doesn't reclaim, just say this 41.5, 42 in the next few sessions, I would say that this lower or this $40 number at least will get tested, if not lower than that.
Moving along to cores, this name was off about 7% yesterday, but again, since its IPO, it's really had some nice performance. And this is one of those names like a Dunkin' and some of the other IPO names that have actually performed well in 2012. It's kind of like, yeah, it's come off, but can you really complain about the performance overall?
No, especially if you got involved, within the first month or so of the IPO. It's all about your time frame. It's all about whether you're trading it for a macro investment or if you're trying to catch an intermediate trend or you're trying to play it for momentum. And right now there is no momentum in cores right here. If you look at the chart, unbelievable situation way back when. This is when it came public. Here's where, it cleared somewhat of a pivot and went on its way after the first month. And wow, look at this. And then you had a gap up, continued. Since then, it was pretty choppy. Then you had another gap up. And it's been holding the gap. It's still overall, looks strong. But then if you look at it short term, traders who were trying to wait for a new high trade, they probably got stopped out yesterday. People were thinking, what, this gap is strong. It's holding up well. Probably on the wish list of a lot of ladies out there, a lot of Cores products. But meanwhile, pow, broke this flag area. This should have been your stop. So momentum guys probably got stopped out yesterday around 51.75. Some maybe even made some money short. I would say intermediate trend traders. Okay, if it starts breaking and getting into this gap, I would say you have to sell some there and then see how it handles the 200-day. And hopefully, a big portion of this gap stays intact. If it doesn't, you will see more selling pressure, especially if the retail group as a whole doesn't find some footing.
Well, what I think what the issue is too with this space in particular is that it's probably trades as the most highly correlated of all the groups that we take a look at, where it's really tough if you have a great individual name like a TJ Maxx or a Cores, where things are good there from a fundamental perspective, but it's just going to trade in sympathy with the rest of the group. Even a name like a Coach, another retail luxury brand, down just about 6%.
Well, this one's been a laggard all year.
Right.
This one broke earlier, tried to rebound. You look at the chart of Coach here, really giving you no reason as a macro investor to be in it. Here's where it broke earlier on. Remember when the market broke, this one broke even harder. Here was your top, broke below this, broke below the 200-day moving average, which now has been resistance, broke below it, really got crushed, came back, kissed the 200-day, came back, tried to find support, kissed the 200-day twice. Looked like it was going to get through. It didn't. And now, but overall, it's below the 200-day where I just showed you some just getting to it. Stock closing the dead lows yesterday. So at this point, to me, it's a full-fledged avoid and avoid with with authority. And if it does break below this macro area, this 52-ish, 52.70, these lows here, should be tested if not taken out.
Moving along to Macy's, another one for 2012 that investors liked. You have a nice healthy balance sheet, lots of cash, it has that dividend, so you're kind of paid to hold a name like this. But again, we're seeing pressure here. I also think with the retail group overall, the promotional activity, and I'm one of those people who wait till Christmas Eve to finish my Christmas shopping. I could not believe how promotional retailers were, 60, 70% off everything in the store. It makes you wonder, where are these margins going to come from?
There you go. So you put 1 + 1 together and you get, lower prices.
Right.
And at this point, you look at Macy's, which is, again, depending on your time frame on your entries and exits, it's been a good trade, and it's also been time for pressure. And if you look at it right here, you will see, you almost have like a rounding top here where it broke this trend line. I guess I drew this trend line, a few days back when we checked it, and list 2 is below the 200-day. So, I look for stocks that show relative strength. I look for, groups that are above all their moving averages. And as I look at all these charts, a lot of these retail names are now below all their major moving averages, so they need a lot of time to rebuild some of these charts before they're going to show you some leadership or some alpha. So at this point, they're a bit of an avoid.
And finally, let's wrap it up with Saks, a luxury department store, SKS.
Saks. Okay, let's take a look real quickly here. This too.
It's telling the same story.
Same story.
So you could see how highly correlative that this particular group is.
Yeah, and this one definitely is one of the weaker ones within that group, so I don't see much exciting things there.
All right, well, bah humbug to the retail group.
Yes.
We're going to jump into a quick commercial. When we come back, we dive into the trenches.
Hi, I'm Sean Hendelman of T3 Live, where we train, coach, and mentor traders in order to help you put your money to work with confidence. The T3 Live approach is a blueprint for you to recognize, adapt, and ultimately take advantage of different market conditions. To begin your training with T3 Live, we would like to offer you the opportunity to enroll in our free 30-day online home study course. Fill in your name and email address, and I'll see you on the other side.
Welcome back to the Morning Call. We're going to dive into the trenches and look at some of the scariest names to trade in 2012, and this is why every trader has a Costco-sized bottle of Tums on their desk. Let's kick it off with Facebook. This thing was a complete mess from the IPO process, and it's come back a little bit, but I still think this is one of those names where you're still going to see a lot of choppy action if they deliver some consistent quarters.
Right, well, they're looking for mobile growth, and I do think that this will be a bright spot next year. There's been a lot of places to be involved and a lot of places not to be involved, and when the deal came public, it was one of the most hyped deals out there pretty much ever, just because of the world we live in now with social media and whatever. But it followed the same rules as everything else, where the stock didn't close anywhere near the highs the first day, so it showed you no quick commitment. It closed near the lows, and then it closed below that new issue price. All situations where you say, okay, back off, get out of the way. And then from there, it's painted a technical picture, sometimes easier to see, sometimes not. If you look at the chart here, you will see this was the IPO day where it closed in the lows, no reason to own it. Then you had your gap down. Then you had a bit of a bear flag right here where it paused, and then from there, it wound up trading lower. And then right around here is when it started acting better. I think I even went on TV saying I think at this point it looks like it could start getting back up there, and then it broke a key area, which was an area to get out. And then you had your bad earnings, and then PS, fast forward, if you weren't involved in it, there was a nice little cash flow situation here where 23.5 was a nice little buy area. This was your add-on, went as high as almost 29. And then from there, it's consolidating. So I think this is very interesting right here to watch. I'm long a little bit, but again, I have tight stops. If you're long this thing, I think if it breaks below 26, you could see a retest of this 24 area. If it holds this 26, goes sideways, and you want to stay involved, I think you can. Then if it starts to get above 28.80, it's no longer that scary, and you could potentially get a move back to 31.32. So right now, it's trying to digest a really nice move from the $20 area, but at this point, you have to be very small and see which way this flag type pattern resolves.
Moving along to Zynga, and this one certainly was a mess. Even the secondary priced at 12. You're not too happy if you got involved then either. It makes you wonder, were the bankers, what were they looking at when they were pricing names such as this? I mean, what does the company even really do? It's so dependent on a name like a Facebook, so it certainly has gotten hit as Facebook came in.
Well, you know what they were doing? They were watching out for, I guess, whoever they got out of the private placement at $12 and didn't care who they got in. But I think at that point, everyone had Facebook colored glasses. And I know I have a lot of smart guys that were sales traders that we talked to, this and that, and everyone I think really thought that this was going to, go to 20. I remember everyone saying, oh, Zynga, when Facebook comes out, it's going to be 20, but everyone also thought Facebook was going to get to 70. So both of them that moved together just got crushed and tried to take people away from the fact that it was Zynga, social media, and just look at the chart. Because if you look at the chart told you exactly what was going on. You don't even see this in a textbook so clear cut. This is what you call a shooting star top. This is what you call as a topping pattern. Yes, there was a nice trade right here when it traded above the IPO price, wide range bar, boom. But right here when it opened up on good news and sold, that was your short-term topping tail. And then when it broke this, trend line, another advertisement to get out. And then you had your secondary, and if you ever break a secondary price, that's not good. And not only did it break it, it broke it with authority. So once it broke this area, your last line in the sand, around $11, I think this was the last time that I said, I'll give this a try here. You then had a quick move down, and then it broke another support area, and then it's just been a mess. So the question I think guys are saying now is, is this a trash for treasures trade where You could buy it here at 240, and see some type of, gap fill back to, $4 or so. And there's been some news about gambling, games for it and some this and that. I tried it once or twice, but really, I don't think it's worth your time. At some point in January, if it does get a January effect type of situation, if it starts trading above 260 with real volume, then maybe you get a trash for treasures trade back into the 3s or 4s. But at this point, it's a full-fledged avoid unless something really changes. And unfortunately, if you got stuck in this thing, figure out where you wanted to get out. Figure out if you were listening to people. Figure out if it was a tip. Whatever it is. Look at the price action and see where you went wrong so you never, ever get bagged like this again in the future.
Moving along to JCPenney, not only was this a mess from a chart perspective, but fundamentally, investors were a little bit excited when we had an Apple employee come in as the CEO, but what they did is they took the pricing model that they used for just 4 or 5 products that Apple has and tried to apply it to an entire department store. And if you look at same-store sale comps, clearly shoppers weren't happy with that. In fact, I heard this morning on the news that for the holiday season, Amazon got the best shopper experience and JCPenney, from an online perspective, got the worst. They just can't get out of their own way. The only good thing for 2013 is it might end up comping well, because 2012 was such a nightmare. Right. But that's almost like making your quarter because you cut costs, not by building the bottom line.
Yeah, but it's, for someone's bad entry is someone's good entry.
Exactly.
And this one's been in a downtrend. It's giving you so many different ways to get out of it. If you look at the chart here, you will see that, again, you don't buy it by excitement. This is when, it was on this high perch. Remember this? This is, I think, probably on the excitement that they were getting, the Apple guy, and then it broke. And then came all the way down, and then look at this, right, hovering on support, big gap down, never was able to fill it, went all the way lower, and finally had a nice move back to this trend line, which was a resistance, came in, back to the trend line resistance, and then it capitulated all the way down. And now I think some guys are actually making a little bit of money trading it off the lows. It'll be interesting to see what happens here today, because I did see that report also. It probably is down a little bit because of it, but overall closed strong yesterday. Well, all the retailers that were good this year are all coming off. This one's coming off the lows. So at this point, I think that there's a trade here. Maybe it can make its way up to 23. But again, when you're trading a laggard stock off the lows, you just have to be very careful.
Moving along to Green Mountain Coffee. Now, if this is not a textbook example of how a name can move on headline risk, have someone like an Einhorn come out and say, I'm shorting it, and there you go. And then you have someone also like a Herb Greenberg beating it up on CNBC. So, there definitely were some fundamental and technical issues here, but this is certainly one of the best examples how a name can move just on a headline alone.
Right, and it also goes to show you that pricing and timing matters, where this one got battered and bruised. It was like a great stock years ago, trends broke, momentum left, and it got punished. But then after getting punished, it created a lower level base with a heavy short interest. So that excites traders like myself, because they move when they want to move. And I know Sperling, some of the guys, we've been watching it. There's been trades to be taken lately. You look at the chart here, you will see that, I remember, right around here, look at the size of the squeeze that came in. This was right around 25. Here was obviously this hurt. If you were in this, you had a huge gap down, never filled it, no reason to be in it. This was your stop if you tried it then. Came off those lows, another gap down, and then from here, this gave you a nice little 3-day squeeze. Came back down, so somewhat held support, had another wide range bar right there. Then this was the last gap up on earnings, and since then, it held the gap and shorts have been trapped. I would think there could be one more trade here, one more. But again, don't get as big as you got if you were pretty big right here or even right here. But if this were to get above this, just say 42.73 with any kind of volume, any kind of size, you could see a little bit of further upside action. But again, this is just a cash flow trade as it tries to fill this last gap, which gets filled at 48.62. So watch this area. If it were to get above this, there is a short-term trade for cash flow there.
Moving along to quick hits for quick cash, and this one is not going to be too quick, because we have to talk about Apple going into the end of the year and what we think we could see going into Q1. Because again, this is one of those names where it is very consumer driven, but it also is a big tell in the technology space.
Yeah, and this one, I hate to say it, but technically it's shown you where it was going to go. It had a really big move from 2 quarters ago, the earnings. It followed the 8-day, the 21-day, all the way up to the iPhone 5 release at 705. Then from there, it basically failed every test. Every time it tried to bounce, it couldn't, showing you that it was heavy, showing you that it was pressured. You take a look at the chart. I'm just going to run through it real quickly. Here was that head and shoulders top. Remember this quick move where it held and followed the 8 and 21-day. Right here, you didn't know it was going to go to 500, but you didn't have to if you exited your position as the trend changed and it broke the 21-day. So here, broke the 21-day, couldn't get back above it, broke the 50-day, went to the 100-day, small little feeble bounce, broke the 100-day, couldn't bounce again, broke the 200-day. Every test of what could have been support failed. So if you don't see commitment in the stock, you don't show commitment. And then boom, down to finally a nice reversal here that gave you a more sustained move to the upside that got contained by this downtrend. Then it really came in quickly, which was a negative sign, and now look where it is. It's really in a danger zone. Yesterday the low was 511. You have a point of reference at 510. And then you have 501, 505. Question is, can we see a small trade here? I know I've been looking to see if it could happen where it could get above this mini downtrend, maybe above 525 for some kind of bounce back to 550. But as it looks right now, it might not transpire. If it does, I'll be on it. If it doesn't, I'm out of the way. Because if we get a close below 501, 505, you will see a lot of more people talking about this macro pattern, which is pretty ominous, where you have a huge head and shoulders pattern, where below this you have 486, and below that, you have 440. So just be very careful here as we enter the new year with Apple.
Right, and I happen to agree with you because holiday sales are not coming in that strong, and really the story was for Apple was to get that holiday 2012 bid, and going into Q1.
I think the sales are there. I really think that, retail sales are lower, but people are buying the iPads. They're sold out. I think the iPhone supply is there. So I think that if it does get crushed into earnings and goes down, I will be taking some kind of call spread into the number. If it doesn't and it bounces beforehand, shorts get squeezed, I'll be long at above 525. But I'm treating this very incrementally. I still think, like you've said, it's really the capital application to Apple with the new environment we're in. It's just hard for investors to buy it up here. Even hedge funds that have a lot of funds, it's battered and thrown around. So they need to split this stock in order to make this into a proper investment vehicle again. Maybe Tim Cook delivers, in January and finally, gets us back in gear. But for right now, take a short-term approach and we'll see where it is come earnings next year.
Moving along to Priceline, this is a name that we looked at going into the Thanksgiving holiday weekend. We saw Priceline, Expedia, online travel names that were outperforming traditional names like your Marriott, your Las Vegas Sands, and your Wynn, but we've really seen a reversal in composure.
Yeah, and I think in my 2013 projections, I will say I think this is something that can get hit next year. I said that before, but maybe this is the time. I don't love their model, and I know their PE is high, and a lot of shorts have been trapped. But anyway, you look here, and technically, you've seen a few faulty signals. Here's your short. Here's when it looked good. It held the gap and traded through this. Nice little trade, and then here's your red dog reversal. Here's another negative day to confirm it. Boom, now it's breaking into the gap. So at this particular point, if it's up a little bit with the futures, some guys might try and short it. And if it trades below yesterday's low of 600, you could see more of this gap get filled. And the more of the gap gets filled, the less pent-up momentum you have there. So I would say, guys, be careful if you're long. I would even sell it. And if you're trying to trade it from a short position, be careful because of the swings are wide. But, trade and close below 600, and you can see 580 pretty quick.
Moving along to online shopping, we'll take a look at Amazon. And like we mentioned earlier, it got rated #1 for online shopping experience for holiday 2012. But just like the retail names, they're trading so much in sympathy that, you wonder if it really, fundamentally it really is doing well, but it's just trading so correlative to the rest of the group.
Well, fundamentally, I think a lot of people are scratching their head. It trades at such a high PE, and they always give it a
compressed
pass.
Margins.
Exactly. So they think the margins will get better, and then that's when their earnings come in. But anyway, you want to trade the levels, and you want to trade your time frame. And if you look at the chart, from when it triggered through this descending channel right here back in November, you had a fast, furious move all the way to the highs. And then it did look like it could hold higher, maybe be the first high beta name to break above, but you know what? It didn't. We trade real time, switch gears. This was my level. This was like 255-ish, 254-ish. I said, if you're not in this for the long term, here's your stop. And some guys actually made money short yesterday because it was down $4 or $5, and they said, you know what? This is going to get a hit with the rest of retail. It's not immune, and it did. It closed in the lows, right into a bigger support. It could be up like probably $1 or so maybe on that news, but if it doesn't rally and get back to say above, a third of this wide range bar, above 251, it stays in this danger zone, and then I think guys will be adding to their shorts below 248, and then you could see 245, maybe even 241. So at this point, be a little careful with Amazon.
And let's wrap up quick hits with a financial name. This was also a nice surprise for 2012 as the entire group has started to improve as the housing recovery is improving. And we're hopefully, as we get some more clarity into the fiscal cliff, this will be a group that will continue its momentum into 2013. It's going to be really key to see how businesses and people put their money to work.
Right, and the banks have been a source of relative strength. So in order for the market to have any footing, that has to continue in January. And Goldman Sachs help lead this
the
move.
way.
Bank of America also leading the way. If you look at the chart of Goldman, you'll see this was the last time it triggered above 120, and now it's trying to flag here. So I would say it will be very positive. Goldman could stay above, just say this 125.60 area, moving sideways. Come the new year, new flows come into the banks. You could see a breakout above this 129.72. I don't like the fact that I actually can't even read too much into it. It just wasn't ready to break out yesterday because you saw something like a Bank of America break above it and close near the highs. So that just shows you how confusing it is for traders right now, where you have a strong group like the banks, but not all of them are created equal. And this move in Bank of America from $10 to $11.50 has been fast, furious, technical, and rewarding guys staying with it. And Goldman's been similar, except for yesterday, it wasn't ready to break above highs. So I would keep that on the radar and look at this for potential clues on the banks alongside JP Morgan, Wells Fargo, and Citigroup.
So to wrap up, let's just recap some of the themes that we've been talking about for 2013. One thing that we've been looking at is CapEx spend really moving. We see some momentum there. So that'll be the industrial space will certainly get some support there. The technology names will certainly get some support. Names that are focused on services and analytics, like your IBMs, your Oracles, your CAs. I also think that you're going to see a lot of cash come into the market, and we could see some really nice M&A and LBO activity. Not only from a speculative momentum trading perspective, but also fundamentally see some nice industry consolidation. But what are you looking at in terms of themes for trading? Like for the end of 2012, we looked at being real tactical and picking your spots.
Right. Well, it's the same with this, because I think last year it was pretty obvious that we're going to break above the wedge and have a nice first quarter move, and a lot of people are expecting that. They think that we're going to get some kind of fiscal cliff resolution, and boom, it's off to the races. I'm not that sure. So at this point, short term, we're in this confirmed rally from November 16th, so I want you to stay with some. So in my head, I have like 3 different themes going on. As long as we stay above 14.11, 14.15, I think the rally is in the game. If we close below 13.95, I think you're going to see more distribution, more selling, and we could retest, the 13.43 area real quick. Okay, and that could be the fake out in January before a move higher. If we hold in there, I think we close above 14.50, then that 14.74 September highs, could happen quick, and then first quarter, if we close above that, 15.20, 15.40 is doable, and that would be the same type of trend we saw last quarter. So right now, I'm in wait and see mode. I'm in flexibility mode. I'm not making any big bets, coming into the new year. I think that there'll be more than enough time to put your money to work, figure out which way we're going. We had 3 intermediate trends last year, all 3, pretty profitable. First quarter, you had a nice trend before the top coming into the second quarter. June 4th low, nice trend before failing into October, and then the November 16th intermediate trend. So we've had 3 different trends that if you rode them and put risk on, you created alpha and cash flow. So right now we're in the midst of of an uptrend with some faulty signals. So we need to see which way it goes, because we're bent. I wouldn't say we're broken, but I don't think it's just a shoe-in that we get a powerful January move like we saw last year. So I just want you to be a bit cautious, because if you go in there guns blazing, and we do have a 3 to 4 handle pull in, and you get scared out, and then we rally, you're not doing so well.
Right. Well, the good thing is that there always is an opportunity in the market. If you stick to your plan, you remain disciplined, and you check in with Scott every day in the morning and at the end of the day on options, profits, real money, and T3Live.com as he wraps up the charts for us every single day. So from our family at T3 and the Street, have a very happy and healthy new year.